Hey there, everyone. Happy Thursday, April 10th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's a beautiful day here on the Olympic Peninsula in the western edge of Washington State. Finishing up spring break tonight, heading back tomorrow, picking up my daughter who is on a class trip to Guatemala at the airport on the way home, and then should get home in plenty of time to do a special all mailbag edition of Chart This tomorrow evening. So please drop your questions in. If you're watching live, put questions in as we go through today's market recap. We'll try to get to a question or two at the end of the broadcast. Anything we don't get to, we'll put in the mailbag. And hopefully on tomorrow's episode, we'll have a little more time to answer questions. Hope to answer one of yours in that discussion. Overall market sort of back on its heels today. Yesterday's big rally pushing a lot of things higher in the short term. As we talked about on yesterday's episode, talk about an irrational move higher after a crazy move lower. Today's sort of back to what I guess feels like normal from mid-February to now mid-April. A steady decline of lower highs and lower lows, deterioration representing lowered expectations about economic growth in a post-tariff world, which is still very much part of our thinking, I think has to be through the course of this year, still very much an unknown. And in general, when something is an unknown with the potential to certainly weigh on companies' ability to generate earnings, it usually weighs on the markets to the downside. Yesterday was a big update, 100% update on the mid-cap index. And as I mentioned, I don't think I've ever seen that before. Today, we're right back down to 90% down days for the mid-cap and small cap indexes. Major averages moving to the downside. Most of the 11 S&P sectors back in the red. If you zoom out on some of the charts that we'll show you, you'll see how yesterday's move was a significant upswing within a clear downtrend phase. And that's how I think I'm pretty comfortable labeling that until proven otherwise. With that in mind, let's continue our market recap and see how things are playing out today. The S&P 500, as I mentioned, in the red, 3.5% lower, and that's after yesterday's big gain for sure. But again, even with yesterday's gain, as we talked about, yesterday's huge up day didn't completely erase the gap lower that we had after the tariffs were announced last Wednesday after the close. The S&P down below 5270. And again, that's a 3.5% cut today. The NASDAQ composite down 4.3%. Dow down the least, about 2.5%. Volatility obviously remaining quite high. The VIX is still above 20, actually pushing 7 points higher today. Yesterday, we're down around 34, 35. Today, we're back up above 40. So again, volatility remains high. Just if you look at the ranges of the bars over the last week versus the ranges of the bars for the year prior, certainly a significant up move. Yesterday, followed by a significant pullback today. Bonds actually moved lower today. The TLT was down almost 3% today. The dollar index down about 2%. One of the biggest moves in the dollar we've seen in quite some time. We actually grabbed the charts of the TLT and the dollar index, dollar sign USD on stock charts to highlight those. Dollar weaker. And so, again, what's interesting about what we've observed in the last couple months here, given the deterioration in risk assets, given the deterioration in the U.S. equity markets, you're not seeing that traditional flight to safety where the dollar starts to rally. It's kind of a general way you think about it, and go back to like early 2022, for an example. What often happens in a confirmed bearish environment, the dollar starts to rally. We're not seeing that here. We're seeing a weaker dollar for now. Rates kind of mixed. The long end of the yield curve actually moved up a little bit. The midpoint of the yield curve drifted lower. So the 10-year point, actually not much change from yesterday, right around 4.4%. The long bond yield down around 4.85 today. Looking at the commodity complex, kind of mixed. The energy side, like crude oil, natural gas, down pretty significantly today. The USO was down 3.33%. Natural gas prices finished lower, about 5, almost 6%. You look at gold and silver, actually moved higher. Gold making another new all-time high, very close to doing so. Might have done it today. I'd grab the gold future to take a look, but the GLD was up almost 2.5%. Silver up slightly less than that. Gold stocks starting to move higher. I did grab the chart of Newmont Mining to show one of the more encouraging breakouts you can find. Cryptocurrencies back on the red side. We can see that Bitcoin down 3.6%, Ethereum down almost 9%. Bitcoin is back below 80,000. Yesterday, as we were recording the show, you saw Bitcoin spike above 80,000, push briefly above 83,000. Today, we're back below 80,000. That ended up being the resistance level so far through the equity trading session today. So back on the red for a lot of the cryptocurrencies here. Looking at the 11 S&P sectors, you can see consumer staples is your best performer. And that was the only one that finished in the green, and it was just slightly so, just a rounding error, 4 cents above yesterday's close for the XLP. The XLU down 0.8%. Real estate, number 3, down 2.1%. Those are 3 fairly defensive sectors at the top of the list. So again, this was back to kind of the themes we've been talking about here in recent weeks. Deterioration in the market, growth underperforming value, defense over offense. This was back to kind of that normal observation. On the downside, energy down 6.5%, technology down 4.7%, consumer discretionary down 3.9%. So again, extreme volatility has been the story for the last week after the tariffs were announced. Even with all of these headlines, obviously just a lot of uncertainty, a lot of movement. I don't know. It's hard to predict where volatility is going to go, but it certainly feels like we're going to be in a volatile environment until proven otherwise. I'm sort of assuming that's going to be the case. And I'll tell you, it's really hard, especially if you think of previous volatility regimes in your head. If you're kind of expecting low volatility and you get these big percentage swings, you're going to feel that those have a lot more signal than they probably do. I think what you have to remember is yesterday, while a huge up day and certainly a significant swing back to the upside, market giving back about half of those gains on average today, right? I mean, so things that rallied a ton yesterday got dinged pretty good, right? Technology down almost 5% today. Elsewhere, we can see that our market trend model kind of volatile here. We're back to short-term bearish on all those timeframes. We don't formally lock in any change until Friday. So that'll be tomorrow's close. We'll keep an eye on that market trend model and see what happens. But for now, back on the bearish side, the breadth back to quite negative. Yesterday, the one-day breadth reading was incredibly strong with a lot of these indexes, 90 up to 100% advancers and very few decliners. Today, right back to where we were from the day prior. 85% of the S&P 500 members closed down today, only 15% higher. In the New York Composite Index, it was about a 90% down day. So significant pullback in those major averages after yesterday's rally. We can see the Magnificent Seven and Friends getting dinged pretty good again after yesterday's significant update. Microsoft down about 2 1/3%, and that was your best performer. On the downside, Tesla down over 7%. Broadcom, Meta both down about 6.7 to 7% today. So this is very much a painful day for growth. I mean, if you look at the Dow industry groups, gold stocks, right? Mining names up almost 5% today. That was your best performer. After that, the top 10 groups are all consumer groups. Besides apparel retail, it was a bunch of consumer staples, random utilities like water names, and that was about it. All right, let's go to the market carpet. As a reminder, I can see questions you're putting in on all the different platforms, LinkedIn, Facebook, YouTube, and X. I appreciate you so much tuning in, those of you that are doing so live. And if you're watching the replay, I appreciate you doing so as well. If you are watching live, feel free to drop a question as they come. At the end of the episode, I'll take a question or two before we wrap for the evening. We're going to try to score one more round of awesome seafood here. Dungeness, Washington is not too far from where we're at here. So the crab, the shrimps, the oysters, clams, all fantastic. Fish for sure, all pretty good. So we'll see what we can get into before the evening is done here. All right, looking at the market carpet, I mean, what strikes me, obviously yesterday, the entire thing was green. It was almost laughable bringing up the market carpet yesterday because it was entirely green. And some things were up so much that it was not varying shades of green. Just everything was kind of the same color. Today, kind of the opposite, right? You've got a lot of things down today. And, over 3%, the histogram doesn't get any brighter. So things that were down a ton are all just kind of that same brick red, telling you things were pretty ugly. So you can see that certain sectors certainly giving back a lot of yesterday's gains, particularly technology, of course, all down most of communication services, most of consumer discretionary. Although you see some random pockets of green in there. Energy almost all down pretty big. And then healthcare, industrials, even materials besides gold stocks down pretty good today. So what was not down? And this is again on a down day like this, where you do see some things up. That's where I'm immediately drawn. United Healthcare, kind of an interesting chart. We'll bring that up. Actually breaking to a new high, very close to pushing back above $600. Within consumer staples, names like Walmart, Coke, Procter and Gamble up about 1%, so not bad on a big down day. A lot of utilities were actually finishing flat. We're slightly positive. So I'm looking at charts like AWK that are holding support. I mean, boy, yesterday was just such a crazy day. It's almost like you need to ignore it and just look at the larger trends that I feel like today is sort of back to what we were seeing before. I did grab some of those random names to review here as we get to the chart review portion of the show, and let's get into it. Here's the daily chart of the S&P 500. This is what I was talking about with volatility. I mean, just look at the ranges of the days and how the average range was just so much smaller, right? Look at these little days that almost look insignificant compared to these huge, crazy volatile swings. Again, that is, I mean, unfortunately, that is when you have the headlines that we've seen out of Washington in the last week. You can see the volatility that happens, right? I mean, the market does not like instability. It does not like uncertainty. It does not like to be surprised with big announcements. And this is what's going to happen. So, I mean, and again, given who's in the White House and their general approach to governance, I can't imagine we're going to have a low volatility kind of experience. Someone mentioned, ready to take a weekend because you're exhausted. I'm with you. I mean, these are beat down days. Even when you're up a ton, it doesn't feel great because you just feel whipsawed. I mean, we're wind burnt from hiking along the beach earlier. It feels like you're wind burnt from just watching this market from one day to the next. But again, I think we just have to assume greater volatility, assume more noise, and just try as much as possible to take a step back and reflect on the trends. I think this heavy purple trend line that I have over the highs is something that I'm really liking. I was looking at this earlier as I was preparing for the show, and I like the fact that just kind of summarizes a general downtrend in the markets. And while we've accelerated off of that trend line here over the last week, that might kind of be one of those lines that's just really helpful to follow, because until and unless we can get above that line, anything below there is noise, which means the last week is just a super noisy, choppy period, but still all remaining below trendline resistance. Same thing with like the 200-day moving average, right? Now, again, the 200-day moving average is kind of getting farther away. It's, up at 57.50, and today we closed around 52.50. So we're about, 500 points away. You know what? That's a 9% rally just to get back to the 200-day moving average. But again, that's the sort of volatility I think we have to assume is going to be more the norm and less the exception right about now. So generally, the S&P day today was well within yesterday's range. So if you look at yesterday, the S&P index opened around 49.70, closed around 54.60. Today, we opened around 53.50, closed around 52.70. So it's just called a bearish inside day, where you have a lower range, an up close day one, a down close day two. It's not bullish. Basically suggests the next 1 to 3 bars probably lower. Boy, we'll see. We'll see what headlines happen here. The chart is a chart I shared with you, I think, on yesterday's show. Something I have on my chart list that I review every morning. Just wanted to check in on again, and what's helpful about a week like this. I think at the end of this week, I do a weekly flight plan for my market misbehavior premium members, and a number of people have just joined as premium members. Mentioned that they followed the show, so thank you so much those that have, and always happy to accept new members into the Market Misbehavior Premium membership. If you're interested, go to marketmisbehavior.com/premium. Make sure you use the code YouTube, by the way, if you do so, for a good deal on your first 12 months on any plan. But I think this week's review is going to be super meaningful, because talk about one of those weeks where it feels like you're just being slapped in the face day to day. Taking some time over the weekend to just, take a deep breath, reflect on what has really changed, and really looking forward to earnings season, which kicks off tomorrow with a bunch of banks, by the way. We did grab a chart of some bank. I might have just grabbed a bank ETF now that I think about it. But again, now with earnings season, I think it's going to be just thinking about where we're at from a technical perspective, think about some of those other macro influences, just try to get a sense of what levels and signals we should be on the lookout for, and just starting to think about what kind of messaging we could get from earnings, and just thinking about key levels to pay attention to. I think this could be an important one. But this chart I often bring up with my premium members just to review, all right, what really changed over the last week? And to be honest with you, again, with yesterday's huge bounce to the upside, none of these changed a ton, right? And I think that's the benefit of things like breadth indicators that are looking at trends over time. One day really doesn't move the needle a ton. And that's kind of by design, right? You're looking for trends and how they're shifting over time. You're not looking for one day reactions. So even with yesterday's rally, even with all the volatility, I would argue these all remain in a fairly bearish configuration. And there are clear levels with most of these, I think, that would change that configuration from bearish to bullish. For example, the bullish percent index getting above 30%, which would mean enough buy signals have emerged on the S&P 500 stocks using their point and figure charts that it really suggests an upside move. By the way, my latest show on Stock Charts TV was all about the bullish percent index, looking at where it is now versus previous bear cycles. So if you missed that, go to the Stock Charts TV YouTube channel. It was my latest video, just posted yesterday, and hopefully gives you some additional insights on how to use that powerful breadth indicator. Same thing when you look at offense versus defense. Here's yesterday's rally, where obviously consumer discretionary outperformed consumer staples, but I mean, generally, I think the trend is still clearly down, right, on both of these, the cap weighted and the equal weighted version. So I think the general trend here is pretty consistently down here. Some of the sentiment data came out. It's almost fascinating to think about how some of these moves could impact sentiment data. What's funny is this is, a lot of these surveys, from what I remember, are open through the end of the day on Wednesday. That might not be true. But I would assume that some people were voting after yesterday's crazy rally. But if you look, not a huge swing to the bullish side for the AAII survey. That's this first one. So the American Association of Individual Investors, you can see 29% bullish, 59% bearish. So not a lot of people kind of unwinding their bearish sentiment, even with all of yesterday's action. Now, again, some of those votes could have come before yesterday's rally. That's true. Still a 30% gap with bears far outnumbering bulls. So the individual investors in the AAII survey still very much positioned to the downside. The name exposure index, which is a survey of money managers and just asking what's your exposure to equities, it can go up to 200% long, down to, I think, 100% short, and basically 57%. That's up from 50% last week, but that's still underweight. So the money managers in this survey not jumping on the accelerator after yesterday, sort of remaining in a very cautious, very defensive stance. I think that is a very appropriate way for a professional money manager to be navigating through this kind of this market. As much as it doesn't feel great to miss a day like yesterday, overall, that's not enough for me to change my general sense of where things are at. All right, let's look at a couple sort of currency commodity charts. Here's the dollar index. And again, this is one of those really fascinating themes that have emerged. If you think about where the market topped out in February, think about where we're at now, almost mid-April, the dollar has been trending lower. And with all the survey or all the tariff stuff over the last week, the dollar is still making a new 3-month low today. So what's not happening is investors getting really nervous and piling into U.S. currency denominated stuff and converting into U.S. dollars. And that's why the dollar often rallies in a bearish market, because people are converting into U.S. dollars to sort of find a safe haven. Boy, I mean, it certainly feels like that safe haven status is just not happening right about now, with the dollar continuing to weaken. I don't know if that's necessarily bullish or bearish for stocks. It doesn't seem great to me. It certainly doesn't, encourage me that, about the U.S. Equity and U.S. economy being seen as a leader at this particular moment. It's more, and again, this is the headlines we've been dealing with over the last week, is basically encouraging other areas of the world to become self-sufficient as well. And again, I'm wondering how, with all the changes that we've heard in headlines and in policy changes from Washington just over the last week, what companies are going to do, what they're going to tell us in their earnings calls about how they're trying to plan for potential costs related to tariffs. They have to, 90 days is still 3 months out, right? I mean, that's something that they still need to be trying to pay for right about now. So we'll see what happens. The dollar weakening and U.S. bonds weakening as well. So you're not seeing, a bunch of foreign investors coming in, converting to dollars and buying U.S. debt. I would argue you're seeing the opposite. You're seeing less appetite for U.S. debt. Rates are going higher. Bond prices are going lower. They did rally yesterday along with stocks, but today closing lower, and the momentum is getting weaker. The RSI had held 40 through yesterday's close. Today, actually pushing below 40. So I'm color coding this down to the bearish shade because the RSI, the momentum, is down in a bearish range. That's what I'm highlighting here with these shaded areas. Is in a bullish trend, the whole range of the RSI tends to move higher. When the trend is lower, when momentum shifts lower, the entire range of the RSI moves lower. And that's where we're at, right? We're sort of shifting into that bearish range, which suggests to me, until proven otherwise, weaker bond prices, higher interest rates for now. That's what the charts are telling me. Gold, indeed, making a new all-time high today. We closed almost above $3,200 an ounce for the first time. Not quite there. It's around $3,180. But this is yet another new high for gold. I have a decent position in the GLD and IAU, which are two ETFs that hold the physical gold, because the chart looks like this, right? In an environment where so many things are below their 200-day moving average, where very few things are above upward sloping 50 and 200-day moving averages, boy, charts like this look good. In a 2024 environment, it's like charts like this are a dime a dozen. It was like every chart kind of looked like this. It was actually harder to find charts that were not in a positive configuration with prices and moving averages. Now gold looks like an outlier, but by the fact that it's above all those moving averages, I think that's a great chart, getting stronger. Here's the chart of Meta, and I just want to highlight again, this is why watching the 200-day moving average can, I think, be quite helpful. We've had a rally in the last couple of sessions. Yesterday, obviously, Meta up big. Today, we opened back below the 200-day moving average. So yesterday, we closed above the 200-day. And so when you see that, it's like, okay, that's great. Do we see a follow-through day today? We did not. We actually opened lower and closed lower, closed back below 550. So that's actually called a bearish Harami candle, right? Or a bearish inside day, if you know your bar charts, right? A big up day, a big down day. Day two's range is engulfed by day one's range. So a narrower range, but a reversal day. It's called a bearish Harami. If you know candle charts, if you know bar charts, called a bearish inside day. In either, however you want to label it, it's bearish. Tells you the next 1 to 3 bars are most likely lower. Also seeing Broadcom, which closed back above its 200-day moving average, back above this thick red line we've been tracking around 182. Today we're back below it, right? Closing below there. So with those huge gains in growth stocks, great for 1 day gain. Did it really change the configuration of this chart? For me, no. I think Broadcom is still below its 200-day. It's still making lower highs and lower lows, right? I get excited when that stops happening. So if we sell off and start making a higher low, make a higher low around 155, you will hear me start to talk about, okay, we're now starting to see signs of accumulation because investors are buying before it retests its previous low. That would be encouraging. I'm not encouraged yet by what I saw. I think yesterday was more a violent upswing, on news, but not really sustainable at this point. Tesla's a really interesting chart here. Look at the RSI that's almost dead even at 50. And this is what that looks like often when you have an RSI around 50. What the RSI is measuring, this indicator here is measuring momentum, right? So it literally looks over a period of time, over a look back period. It says, what's the average up day? What's the average down day? So when we close higher, how much higher? When we close lower, how much lower? And it's a ratio, the average up day to the average down day. And that's why we look at things when they're overbought. That means the up days are way stronger than normal. That's why we look for when we're oversold, because that means the down days are much stronger than normal. But it also means when the RSI is at 50, that's dead neutral, which tells you the up and down days are kind of even. And that's what Tesla has been doing here over the last 6 weeks, arguably, right? We're kind of chopping around. We're range bound between 220 on the lower end, around 270, 280 on the upper end. I put these arrows here just to indicate, I think this is one of those charts where you wait to see which way we break. At some point, we're going to make a new swing low, at which point I think a retest of the April 24 low is probably likely. It's down around 140. We break above the 200-day moving average, which is currently around 290. I think that gets us up to the next Fibonacci level up to the swing high in February. That's around 360. So we're right in that sort of wait and see mode. This is one of those times Jesse Livermore famously quoted as, there's time to go long, time to go short, and time to go fishing. This is one of those spring break kind of charts. Time to go fishing, wait it out, wait to see when the signal pops out, and let's see which way the momentum breaks. For now, I think it's dead neutral. I don't think the chart is necessarily giving you a clear indication which way it's maybe going to head. All right, let's look at a couple of charts actually holding up okay. Costco actually bouncing back above the 200-day moving average this week, bouncing off of support around 875. That's a pivot point that's been tested actually a number of times, most recently last month in mid-March. So here in early April, we're holding that. We're right at the 50-day, so we're kind of right between resistance and support, almost like Tesla. RSI almost dead even at 50. I think breaking above the 50-day would be a nice follow-through. That also get us above $1,000 a share, most likely, which would be a good indication of a further upswing. Costco making a new 12-month relative high today, which is what's interesting to me. United Health Group trending higher through the course of this week. How about that? Gapping above the 200-day. That's on Tuesday's session. Wednesday, now Thursday, continuing to move higher. Relative strength improving. The momentum is pretty strong. We're actually overbought as we test that previous resistance. What that usually means, base case would be probably some sort of pullback from the overbought condition as we test previous highs, but the momentum overall pretty strong. And I like the fact that the relative strength continues to improve. Gold stocks, I think, could be a compelling place to be. I mean, as I mentioned, I don't own gold stocks specifically, but I do own a bunch of gold through ETFs. And I think the story there is very, very good. Gold is actually serving as a safe haven. Traditionally, when risk assets are struggling, when inflation is something you're worrying about, gold, a hard asset, good store of value, tends to do pretty well. It's actually following through on its normal moniker as a safe haven here recently. Gold stocks have been lagging behind gold, physical gold. Newmont Mining actually breaking out. Other gold stocks looking pretty good as well. The XAU, a good example of that upside rotation. Relative strength looking good. It's been outperforming year to date. All right, earnings season really kicks off tomorrow. I think starting, going into next week, we'll be talking about earnings a lot. Because those are the names that are probably going to be on the move. I mean, everything's probably going to be moving around any sort of updated tariff announcements or whatever else, new policy, crazy change that is announced with little or no warning before impact. But barring that, I think the next week or two, in a lot of ways, is going to be about companies, what they say about tariffs, how they are trying to budget, what that means for their business model, how that could impact their ability to grow earnings in the months and years to come. I think that's going to be a big area of focus. We start with the banks. The KBE is not a great chart at this particular moment. You can see we are making a clear pattern of lower highs and lower lows. We rallied a bit yesterday, of course, with everything else, but today kind of giving back almost all of those gains. We're range bound in the last week between around 44 to 50. The momentum overall is more negative, really, since December. The RSI not getting above 60 on any of these rallies. It's more in a bearish phase. The relative strength is going down. So I think if there's a time when banks start to work, a big earnings announcement would be a really good time for the KBE to turn higher. I don't see anything on this chart telling me to get really excited just yet. I'm seeing downtrend and counter trend moves at best, until proven otherwise. All right, let's look at a question or two, and let's see what we see. 3P Investor, thanks for watching as always, my friend. You say VIX hit 82 in March 2020. That was, of course, during COVID. We are nowhere near that level. Markets are telling us things are not that bad. I am going to respectfully disagree with you, my friend, which I don't like to normally do. I'm not a fan of disagreeing, but boy, I don't know. I would say the VIX is telling us things are pretty bad. I would argue. Is the VIX to the level it was in COVID? It is not, and that's totally fair. But how often was the VIX up in the 80s? I mean, less than 5 times in history. I would say probably is true. I don't know off the top of my head, but not many. I mean, I do have the charts, but I probably don't want to take the time to go through it. Oh, here we go. I mean, this is a chart of the VIX going back, 30 years. The VIX was up here at the COVID low. The VIX was up here at the great financial crisis. I mean, but the VIX is the third highest that it's been in the last 30 years. I don't know if I would label that as things are not that bad. I mean, the VIX around 30, maybe you could say, boy, things aren't that bad. It often gets a lot higher when things get pretty bad. This is this is within one of those relatively high levels. Now that's as the VIX was spiking post tariffs. Currently it's down a little bit. It's around 40 here. So yeah, a level of 40 is still a very high level. I mean, if you look at the number of observations, over 40 is rare. I mean, it's got to be less than 5% of the readings are above that level, maybe less. So I would argue the VIX is telling you things are pretty bad right now. And the problem I would say is that the VIX often spikes to those extreme levels early in a sell-off, right? So the VIX actually spiked there the fourth quarter of 2008. We had another 3 to 4 months before the eventual low came in 2009. So again, I'm on the other side. I think the VIX can actually theoretically go a lot higher, with the VIX pushing above 50 for this cycle. That's actually pretty elevated, I would say. One more question, Joe. Thanks for watching on YouTube. The 200-day moving average is no longer going up and about to be crossed by the 50-day moving average. Is that meaningful based on history? I'm guessing you're talking about the S&P there. And let me bring up the daily chart. And I think that's true. The 200-day sloping downwards. Yeah, one of the charts that I always remind people to look at, and stock charts makes this fairly easy. Depending on what charting platform you use, you may or may not have this ability, but stock charts has this opacity setting where you can say, basically make the price disappear. I know Optima has like a little eyeball. It's more like a layer, and you just, take it, just don't show that layer. And I love looking at charts just with the moving averages, right? Look at charts that are interesting and just look at the slope of the 200-day. And when things go from an upward sloping 200-day to a downward sloping 200-day, something has changed quite a bit. So I think the slope of the 200-day is a concern. The fact that the S&P is so far below its own 200-day moving average and doesn't appear ready to reclaim that, I think that's a problem too. The death cross that you're implying, which is the 50-day crossing down through the 200-day, less meaningful for me. And if you backtest that crossover strategy, it's not the most helpful thing ever. And I will tell you it is, but it depends on what's going on, right? I mean, if you have a long-term trending market, look at the S&P from like 1996 to like 2010, it will look like the best trading system in history because it basically told you to sell pretty soon after the tech bubble burst. It'll tell you to buy in after the 03 low, I believe. And overall, it's a pretty good place to be. But in a choppy sideways environment, you'll get a bunch of whipsaws and you'll get false signals. So it's not my favorite indicator to use. Other indicators like the MACD or the PPO, way more meaningful, like RSI, way more helpful in my opinion. However, the slope of the moving average, I think a problem. And to be honest with you, if you think about what this market trend model does, which is the most important chart I have, and it's the first one I look at every day, it's based off of essentially the difference between moving averages, basically looking at the changes in moving average and using that to define the trends on 3 timeframes. So I think that is a fantastic way of avoiding the noise and just looking at the trends and how they're evolving over time. That's what the slope of the moving average is telling you. I'm concerned that the moving averages for the S&P are sloping in the way that you ask about. I don't think that's a good thing. Folks, that'll do it for today. Thank you so much for joining me here for Chart This. Again, I can't tell you how much I appreciate you guys not giving me a tough time for going live anytime I can. We were hiking on the beach here near Port Townsend, Washington earlier today. Loved being able to hike around, find sea glass with the dog and the family and enjoy it. And also good to be back here and looking at the charts. And I'll tell you what, one of the best things that we did was schedule spring break. It wasn't my choice. It was our local schools. But the fact that spring break is happening in the middle of the crazy period on markets is really helpful because I'm not staring at my screen every moment and getting panic attacks watching how things are evolving. I'm looking after the close and just reflecting on what I saw today and drawing conclusions. Good life lesson there maybe for some of you if you're struggling to navigate these markets. It'll be a mailbag episode tomorrow. Should be back home safely, hopefully, and look forward to answering some of your questions there. But in the meantime, have a fantastic evening. Be well, be safe. And remember, it's always a good time to own good charts. Take care, folks.